Imagine this. The stock market is crashing, headlines are screaming recession, everyone's panicking, selling off, hoarding cash and praying for a miracle. But what if, instead of panic, you had a plan? What if you knew exactly what to buy when the economy takes a nosedive? What if the next recession was your biggest wealth-building opportunity? In this video, we're diving deep into 5 recession-ready ETFs that not only protect your money, but could actually grow your wealth when the rest of the market is bleeding red. This isn't guesswork, it's backed by data, real-life examples, and historical performance from the last few economic crashes. Let's get into it. First, let's bust a myth. Recessions don't destroy wealth, they transfer it, from the uninformed to the prepared. Think about 2008. Most people lost big, but some, like those who bought into broad market ETFs at the bottom, saw life-changing gains just a few years later. The S&P 500 fell nearly 50% at the peak of the crisis. But from the bottom in March 2009 to the end of 2013, it more than doubled. The secret? Those who stayed invested or bought more during the downturn came out on top. So, what should you buy during a recession? Let's break down 5 of the best ETF options, starting with the foundation of any diversified portfolio. SPY tracks the S&P 500. It's the most well-known ETF in the world, and for good reason. It gives you instant access to 500 of the largest, most stable U.S. companies, including recession survivors like Apple, Microsoft, and Johnson & Johnson. In 2008, SPY dropped around 37%. But from March 2009 to March 2013, SPY rose over 150%. Why it matters? Buying SPY during a recession is like buying the American economy on a discount. It's not flashy, but it's resilient. A real-life story from a Reddit user shows the power of long-term investing. This individual invested their entire $40,000 savings into SPY between March and May 2009. Fast forward 10 years, and that investment had grown to over $130,000 with dividends reinvested. Quite the journey, isn't it? So, when should you buy? Ideally when fear is at its highest. You should look at valuation metrics like PE ratios. If SPY's PE dips below 15, something that's historically rare, you're likely looking at a generational buying opportunity. Now let's talk about VO. VO also tracks the S&P 500, but it's offered by Vanguard, which is famous for its low fees. And that's where VO edges out SPY with an expense ratio of just 0.03%. It's one of the cheapest ways to own the S&P. Pretty impressive, right? VOO and SPY are virtually identical in returns. Over time, VOO's lower fees could add thousands to your portfolio. Use case. If you're a long-term investor who wants to minimize fees and maximize compound growth, VOO is your best friend, especially in tax-advantaged accounts like a Roth IRA. Pro tip: during a recession, set up automatic buys into VOO. Dollar cost averaging over a bear market can be a game changer. SCHD focuses on high-quality dividend-paying stocks with strong track records of consistent payouts. It screens for profitability, sustainability, and strong balance sheets. Dividend stocks often act as a buffer during downturns. SCHD focuses on companies that don't cut dividends in hard times. Think PepsiCo, Merck, and Amgen. In the 2020 crash, SCHD fell 30%, but rebounded quickly and continued paying dividends. It has outperformed many growth ETFs over the last decade with lower volatility. Example: a retiree who switched from VTI to SCHD before the 2020 pandemic saw smaller losses during the crash and collected steady dividends throughout. That's recession-proof income. Best for investors seeking income and stability. VTI tracks the entire U.S. stock market. That includes large-cap, mid-cap, small-cap, and even micro-cap companies. It's a one-stop shop for U.S. equity exposure. Gives you access to recovery stories in smaller companies, captures the full rebound when the economy bounces back. During 2008, VTI dropped about 37%, similar to SPY. By 2013, it had more than doubled from its lows. Real-world use case. A millennial investor shared on Twitter how they used their stimulus checks in 2020 to buy VTI. 2 years later, that $3,000 investment had nearly doubled. Best for younger investors looking for growth and diversification. Combine with SCHD or bonds for balance. QQQ tracks the NASDAQ 100, home to tech giants like Apple, Nvidia, Amazon, and Google. It's more volatile, but it also recovers much faster after a recession. QQQ fell approximately 41% during the 2008 crisis. but it rebounded over 300% between 2009 and 2013. In recent history, tech leads recoveries. If interest rates drop during a recession, as they often do, QQQ benefits from cheaper capital and investor optimism. Warning, don't go all in on QQQ during a recession unless you understand the risk. It's for those with strong risk tolerance and long horizons. Pro tip, pair QQQ with SCHD to balance growth with income. Start with SPY or VU. These form your core, broad market exposure. Add SCHD to generate income and reduce volatility. Layer VTI for total market upside and small cap rebounds. Sprinkle QQQ only if you want to bet on a tech-led recovery. When the market drops 10%, invest 25% of your allocated cash. At 20%, deploy another 25%, and so on. This keeps you disciplined and opportunistic. Remember, you don't win the recession by timing the exact bottom. You win by being in the market when the recovery starts. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." Recessions aren't just economic storms, they're clearance sales for quality assets. But only those with a plan take advantage. You now have the blueprint, 5 ETFs, 1 strategy, and the next time the market tanks, you'll be the one buying, not crying. If this helped you prepare for the next downturn, hit that like button. If you want more deep dive ETF strategies, make sure to subscribe to the channel and turn on notifications. Drop a comment below. Which ETF are you most likely to buy during the next recession, and why? See you in the next one.